Okay. Well, with that, let's put all the global cues we have to an expert to tell us how the markets will read them, ought to read them. Ed Yardeni, president at Yardeni Research, joins us now. Ed, good evening, and thank you very much for staying up for us. Can you just parse for us the GDP data and the fact that inflation has come in lower than the market estimated? Will this lead to some change in the Fed's positioning in December?
Yeah, I don't know that the Fed is going to change its mind based on the GDP numbers, but we also had some numbers that suggest that up ahead here, looking into the fourth quarter, we're going to see somewhat slower growth, but also see somewhat lower inflation. Inflation is really what this is all about. And I think the Federal Reserve is committed to 75 basis points at the November meeting. I think they're going to go for 75 basis points at the December meeting, but soften that up by indicating that they are going to pause in the first half of the year. And I think that's what the market is getting excited about, is that we're getting closer to the end of the tightening phase. We're at least getting closer to a pause, let's put it that way.
Okay, so closer to perhaps the end or the pause of the tightening phase. The bulls are pretty much back in control of this market, especially in a market like India, Ed. Do you reckon that that could be the order even over the next few months, irrespective of what the Fed does?
Yeah, I think at year end, I know in the United States, at year end, we have what's often called the Santa Claus rally. And the data shows that the Santa Claus rally, which typically, actually, the thought of Santa Claus is that it's from December to New Year's. But we've looked at the monthly data, and it actually starts earlier than that. October, November, December tend to be pretty good months historically, but they tend to be especially good when we have a midterm election in Congress, and that's what we have coming up in early November. So I think the combination of these things are positive for the market. Look, we discounted a lot of bad news in September, and I think the market overreacted. I think there's too much pessimism out there. And I think the year end is going to be a good one, both in the U.S. and in India.
All right. Hi, Mr. Yardeni. Good morning. In fact, Santa's been here in the Indian markets for a while, it seems. We have been relative outperformers, and if we can have a rally towards the end of the year, nothing like it. But what's your sense on the Indian markets and the outlook from here on? Valuation-wise, we're expensive, but we're offering best earnings as well.
Well, I think when I look around the world, I think when investors look around the world, they just see a tremendous amount of risk with what's going on in Europe, with the war, with what is going on with China becoming more autocratic and less friendly to businesses. So when global investors are looking for safe havens around the world, clearly the U.S. has been one of them, and we've seen that in the strong dollar. But another one in emerging markets has been India, and we've seen that in the India stock market.
Ed, how do you read the tech results? Are they, the market may have been done with worrying about the Fed tightening come December, but should it start worrying that the tech results are a pointer to other results also beginning to underperform, other companies also beginning to underperform come next quarter?
Well, these large technology companies, let's call them the mega cap 8, we all know that there's 8 stocks that basically account for, well, they accounted for 25% of the market capitalization of the S&P 500. The way it's going, within the next few days, they might account for maybe 20% of the S&P 500, but that's still quite a substantial representation in the S&P 500. I'm actually very encouraged to see that the market's holding up pretty well. It looks as though the money is leaving the mega cap 8, the large tech companies, and moving to some of the more traditional Dow Jones members, including things like Caterpillar and Honeywell. So that's an encouraging development, is that we're not seeing right now money leaving the market because of disappointing earnings coming out of the big tech names. We're seeing money just shift around to other ends of the marketplace. And I think that's a healthy development.
Ed, what is the number you said? The 8 stocks comprised 24% of S&P market cap. What is it coming down to?
Yeah, the mega cap 8, the largest technology companies, accounted for 25% of the market capitalization the S&P 500 at their peak last year. And now I think it's the way it's going, it's probably coming down to about 20%, which is still a remarkably high percentage for 8 stocks.
Okay. Finally, then, before we let you go, what is the preference towards emerging markets? Or which is the market that sort of tops your list in the pecking order? And do you see outsized flows towards a market like India?
Yeah, well, I'm not saying this because I'm on your program in India. I'm saying it because I do, in fact, believe that the market action demonstrates that investors are bailing out of China, and rightly so, because there's contractual rights, business rights, the right to do business without the interference of the government. That's kind of disappeared in China. And so it's become a very hostile environment for stock investors. And as they look around the world for other emerging economies, I think India clearly has been at the top of the list for most of them. The only problem is at some point India is going to get overvalued and will need some sort of correction. But certainly from the point of view of freedom to run business without a tremendous amount of political intervention. I mean, we all have it in every country, but compared to China, India looks pretty good.
Okay, good to hear that, and that's a great note to end this conversation. Ed Yardeni, thank you very much for joining us with your thoughts.